Bitcoin dominance rising does not necessarily mean that Bitcoin's price needs to be rising alongside it.
I mean, if you ask me with respect to buying arts, I would say just buy or start DCing on your favorite arts from the day of halving.
The knee-jerk reaction is to think of like the Trojan horse scenario where BlackRock's coming in with the Trojan horse. But I think ironically, like Bitcoin might be the Trojan horse and they're letting it in the gates willfully.
Welcome to your weekly Alpha Bites, an inside look into the minds of analysts hunting for tomorrow's alpha. Today, this is Marconi White, and on this week's show, we're going to be asking what actually matters in crypto, including BTC dominance rises above 50%, is alt season next, what we can expect to happen if the BlackRock ETF is approved, and whether it's time to play the Grayscale discount, and a whole lot more. In the studio today, we have JJ, Ben, Lily, Cody, and Benjamin. Welcome. Glad you're here. And we've got a lot to cover, so let's just dive right in. We're going to start off with a market update. JJ, I want to kick it off to you. In the last 7 days, Bitcoin dropped to a low of about 24,800. It's now sitting above 26,000 at the time of recording. Are you buying this rally?
Hey guys, yeah. So like Marconi just mentioned, last week we kind of got that wick down that I was looking for into the high 24,000 range, and now we're back above 27,000 at time of recording. So just a few minutes ago, Bitcoin crossed back over its 50-day moving average, and it's now above 27,200, moving towards the 50-day moving average at 27,560. Obviously, it's still early in the week, and we have a big monthly close coming up, so kind of expect some chop, but this is a very bullish structure right now for Bitcoin. DXY backtested its 50-day moving average. Right now it's sitting directly on that at 102.60. Over the past week or so, it's been rejecting from there. So kind of if we get a confirmation of Bitcoin, if it moves higher above that 27,500 range, at the same time DXY starts to slide below 102 right now, I think it'll be a pretty bullish setup into the end of month and beginning of summer. Obviously, we've had a lot of bullish catalysts coming up, so it does seem like the market's confirming that right now. Obviously, intraday moves are hard to judge much off of until we get some kind of daily and weekly close, but as of right now, it's looking very bullish.
So this is the most bullish I've heard you. I can hear it in your voice. It sounds like you're buying this rally, at least the first part of it.
Yeah, I mean, I kind of laid out that scenario that I was really looking for last week, and we got that confirmation. You got the extremely bullish announcement at the lows. You have a bunch of people that were short expecting a breakdown to the 200-day moving average like we were speaking of last week. And when that doesn't happen, and you kind of have all of those negative catalysts that had come over the past few weeks, you saw those priced in. Now all of a sudden we have one of the most bullish catalysts imaginable, and there's still a good bit of disbelief in the market over it. So hard not to be bullish here from that vantage point, given what was withstood over the past few weeks, and then obviously, the counter move to that I see as way more bullish than anything the SEC delivered. I think BlackRock and Citadel and the like endorsing it is obviously much more bullish than anything Gensler could deal out. And I think their power supersedes his in my eyes. And I think the market's confirming that right now.
Now, is this creating a bottom for the market, really the bottom of the bear market? Or is this really... I think a lot of people may be asking themselves, okay, are we going to start seeing some really strong price action going further north? I feel it may be more of us creating a really strong structured bottom. So over the next 18 months, we can start to see some growth. What's your perspective?
I do think, well, like even if we break out from here, it's highly likely within the next 12, 18 months that at some point we come down and retest this range, whether that's a flash crash or we move down slowly. But in terms of this summer, I think momentum from here, especially if we get a monthly close, say above that 27,500 range for Bitcoin. And obviously, if that's paired with DXY falling below the 100 mark, it's just, that's a bullish setup. You can't really slice it any other way. Sometimes things are just as obvious as they seem. And when you have a $10 trillion asset manager entering the space, it's bullish, anything is a trap. I think we all have so much PTSD from like the past year that we're always looking for reasons why things are more bearish than we expect. And sometimes it's just as simple as it seems. And that seems to be what the market's saying today.
I'll tell you, my therapist has given me techniques. I don't no longer have to see bears in my nightmares. So yes, you're right. It's possible that we've got the PTSD and we're not able to see the light starting to shine through in the darkness, so to speak. Ben, you've talked a lot about this summer, looking at it as being the point where you're going to see some, I guess what JJ just called the flash crash. Any thoughts here that you want to share, what we're seeing in terms of price action in the market?
Yeah. Hey guys, how you doing? Not much difference in opinion on my side after the sell-off that we kind of saw after our uber bearish episode last week. Things just got overextended, and we had some nice price action on the pivot there. As far as what to look for this summer, one of the things I have on my mind is what's going to happen on the end of June options expiration. It's a quarterly contract. It's got some pretty good open interest on it. I've kind of been expecting that we're going to be right around that max pain. I believe it's still around 24,000. I don't have that in front of me, but where we're at right now, I don't necessarily see us getting too much higher from here. If we do, it would feel like we're getting a little ahead of our tips on the skis there, ahead of ourselves, and we would need to reverse and kind of stay in this trading range. Do we retest the previous low? I'm not entirely certain that's necessary, but if anything, I would have to imagine a bit of sideways throughout the summer and kind of building up to a good Q4 here.
All right, so there you have it, folks. We have the bear sentiment from last week matched with today's tepid or kind of bullish sentiment coming both from Ben and from JJ. I'm very interested to see how the summer progresses and whether this truly does mark sort of the beginning of the bottom, the beginning of the next bull cycle. But that's
OPEX is huge too, the options expiry, because I think if we do kind of accelerate through here in face of all that obviously resistance overhead because of the outstanding call interest and whatnot, I think that actually makes it even more bullish. Like if price moves despite that, like you have kind of that overhead resistance and price moves up in spite of it, I think it'll create a pretty bullish setup in the summer. But something to be aware of, that it could kind of revert from here and just find that max pain point again. We're back in range.
But the structure does look to be changing in terms of like September and December call option structure.
Yeah, that's a good point. I saw some people stepping up and buying calls after the BlackRock announcement.
That's what worries me as well, that people are buying as a result of the announcement rather than any improvement in liquidity. So we're not seeing much of an improvement in liquidity across the order books, globally speaking, across the exchanges. The money that left over the past couple of weeks as a result of SEC announcement and lawsuits over multiples of exchanges, that drop in the order book has not returned yet. So I do feel that people are getting a little ahead of themselves, and it's possible we see this rally continue all the way even up to 30K. But the key point is 32K. If we are able to consistently close and retest 32K as support, then I think we have another 30% rally at the very least to look at. So I think it's not required that you have to start buying here, even though we are above 250 moving average. I think there is still time for confirmation. I think people are still rushing in over here.
Yeah, I agree with that. Typically, you're better served buying the major or the back test of the major breakout, which would be kind of where we shot up over 32K and then retest it. That's probably where your best risk reward is, as opposed to trying to dive in now if you've missed the move from the lows.
So, Benjamin, I know you're going to be talking about liquidity in a few minutes, a little bit later, but you're really pointing out we're seeing some good price action relative to the moving averages, but the market structure still remains bereft of liquidity. We're still lacking.
Yeah, we're still lacking. And I think even though on technical analysis, we are at a few resistance levels that we have consolidated below for quite some time now for the past couple of months, and we could break it through and we could start rallying. But if you did not buy it 24/7, is it time to buy here? I would be skeptical about that. I would say rather wait for 32K to break, wait for 200 weekly moving average to be recovered over a weekly close, and then we can talk about it. Right now, we are still below, on a weekly close concerned, we're still below 200 weekly moving average. Sure, this week we are starting to trend above it a little, but we have to see how the weekly closes.
Okay. So we got JJ kind of buying it. We've got Ben neutral but optimistic, and we got Benjamin not really buying it, but keeping it in the back of his pocket in case it gets better and confirms. So I suggest you check in with us next week. We'll keep you updated on our thoughts here, whether or not this continues to move forward and move in the direction we all hope it moves into the bull going forward into the summer. Let's move on and look at some data here. Ben, I want to start with you. As part of the discussion over last week with Bitcoin moving up, we've also seen that its dominance has risen above 50. And if history rhymes, what does that really mean for the market? What are you looking at? How are you looking at this metric?
Yeah, so the Bitcoin dominance chart just crept above 50%, and it almost felt like a silent move that went under the radar. So for those that aren't familiar with the chart, you take the entire market cap of crypto, and then you figure out what percentage of that amount is made up of Bitcoin. You can determine what Bitcoin's dominance is on TradingView. That's BTC.D for that chart. So if you look back at the last 2 years, it's kind of been in this trading range below this 50% threshold. It's now approaching 51%. So this is kind of a significant moment. If we look back to kind of the 2018, 2019 crypto winter, finally on, was it April? It was a Fool's Day rally. In 2019, that ended up not being a Fool's Day rally because it kept on going for I think all the way out to July. And the dominance chart finally topped out. So it took some time. And if we look at that price action on the dominance chart over that period of time, we can see it's got a lot of similarities. And we see that today. So is it going to run up to about 53, 54%? I think we will see that. That doesn't necessarily mean that the price of Bitcoin is going to be rising alongside it.
Yeah, so you're saying that we could just see some bleeding from the rest of the market rather than Bitcoin accumulating. Is that right?
Yeah, really just Bitcoin dominance rising does not necessarily mean that Bitcoin's price needs to be rising alongside it. So to your point, yes, it could be a bit of a slow bleed.
Look at the altcoin chart too. Altcoin market cap is basically right back to where it was post FTX. So a lot of that plays into it is just everything that the SEC is kind of levered in recent weeks and the shutdown of exchanges and whatnot. You just kind of see that, like Benjamin mentioned, liquidity evaporating, and it evaporates from the riskiest sectors first, which is the alt market. So natural that Bitcoin dominance would kind of move up right now.
Yeah, Bitcoin's essentially crypto's liquidity milkshake. As liquidity starts to dry up, it kind of goes into Bitcoin.
That's a good analogy there.
You better be prepared for a copyright claim on that statement. We all know who's going to be coming in for that one. From an alt trade or altcoin purchasing perspective, I would imagine the market's looking for some higher dominance before they start to buy up some alts.
Yeah, so that's a bit of an interesting way of viewing this Bitcoin dominance chart, because prior to the last halving in May 2020, the dominance chart topped out about 8 months prior. So that's a pretty significant amount of time. So this coming halving, it looks like it's April-ish 2024. So if we were to use that 8-month timeline, we're coming up on it pretty soon. So that led me to look at the ETH BTC chart. With Bitcoin dominance chart in the back of my mind, if we go ahead and look at the bottom of ETH BTC in the last kind of halving cycle or bullish cycle, that was September 2019, which I mentioned that was kind of the top when it topped out on the dominance chart. And it went ahead and ran from that moment from just below 0.02 all the way up to looks like almost 0.08. So it was a pretty significant rally. There's a little bit of similarities in terms of fractals. We have the old McDonald's pattern with the double top taking place. And if we start to be able to see Bitcoin dominance topping out here in the next couple months, and it starts to look like that, this is the chart that I'll be having front and center on my screen. So just keeping it in the back of the mind for really this summer.
Okay. Any other thoughts here on this dominance? Counter perspectives, perhaps, Benjamin?
I mean, if you ask me with respect to buying arts, I would say just buy or start DCing on your favorite arts from the day of halving. Like, do not even bother to buy anything at the bottom. Do not try to purchase anything right now. Because historically, if you look at it in the past 2 runs, if you were to start looking into altcoins and start buying into them from the day of halving, you would actually have astronomical gains compared to, trying to buy in at the bottom and hold it. Like, you'd literally make 10 to 15x. Even in the 2020 to 22 cycle, if you look at it, if you just started buying in the month of May when the halving happened, whether you bought Bitcoin or not, but if you were to buy altcoins, because Bitcoin, if you see, basically it went from around 10K, it went to 69K, right? That was the peak. But if you look at altcoin market cap, if you remove Tether and USDC and, the stable coins, and if you look at altcoin market cap, basically the May top was around 52 billion with respect to altcoin market cap, and it went all the way to 850 billion. So everything before that is just noise. It can just be a trap, and you don't have to allocate funds and lock it in before that. And when the halving happens and when things shift and starts trending, you already know everything is going to go up. So you could just join it then.
I think I'm going to give you a new nickname, which is just patience. When everyone else is kind of looking at the market and seeing these signals that start to trend in the direction of bull, you're able to put a little bit of calm. And by the way, just to reiterate a term that we say all the time and is in our disclaimer, these are all just opinions. None of this is financial advice, including what Benjamin just said, which was to hold on. Although it sounds like being patient may be the wisest course of action for those who like to hear opinions from anonymous people on the internet. I think that's a good perspective, though, for those who are asking themselves if they have dry powder, whether or not it's time to jump in. There's still a lot of movement that's going to happen over the next several months going into the halving. And to your point, the math, or at least historically, there's probably other entry points. So
Halts are so narrative driven too, that like trying to figure out what's going to be the hot narrative post-halving right now is impossible. Like, it's going to probably be a different batch of coins than people are aware of right now. So you're better off waiting for that reason alone.
And I'll chime in real quick, which is on that chart with the ETH PDC, and this kind of dovetails into a lot of this altcoin conversation, is there was a lot of change to ETH supply that we haven't really figured out what's that going to do in a bull run. And the drawdowns on that chart haven't been as significant. So that's one thing that I'm more interested from kind of an economist perspective of what happens with these fundamental supply changes and then how that results to price action to the upside. So almost more of a observing fan to see what happens.
And I want to see a lot more of that, Ben. Let's bring up some more of that data and get a better sense for what is that sink, which is really if I think about the last Bitcoin rally, we talked a lot about the Grayscale trust being this sink for Bitcoin. And now we have, with the staking power, with the staking mechanism, a massive sink for ETH. So yes, I think it's a very interesting topic and narrative. And I think that actually dovetails into the next conversation that we're going to have here with JJ, which is looking at the GBTC and the ETH discount and what that looks like today, because that was such a prominent factor in the previous cycle. So JJ, do you want to walk us through what you're looking at and why I think the market could be asking themselves whether or not this is something to investigate further?
Yeah. Some background on these is that they're trust products. So basically they take in the physical Bitcoin and Ethereum in this case, and I think they own a basket of other alts as well. And then they issue shares, and the shares are kind of backed mathematically. I forget the exact ratio. I believe for GBTC, 1,000 shares is the equivalent to 1 Bitcoin minus their 2% management fee, if I'm correct on that. So basically, you can buy up the equivalent of Bitcoin, but you own it in a derivative. It's based on these Grayscale shares, and they're not pegged to the price one for one. So Bitcoin's price could fluctuate, and these don't have to match it on a 1-for-1 ratio. For example, today, the Grayscale Bitcoin Trust is up 7%, and Bitcoin is only up 2% on the day. So there's a wide range that these can trade in, and there's nothing tethering them to the price of Bitcoin, despite the fact that they are pegged to Bitcoin physically. They are backed by the physical coins. The reason why they slid so heavily is obviously people were leveraged up against them in 2022, like we saw with 3AC and BlockFi and the various other blowups. So they fell to a deep discount. I think it was below 60% even at one point. And now we see it's kind of gotten bid up throughout the course of 2023, especially so this week. And now it's back into the 30% discount range. So you could essentially buy one Bitcoin's worth of value for around $16,000 to $17,000 right now. And Ethereum is at about a 50% discount. So kind of, I think what the market narrative here is that somebody is going to be looking at this if the SEC case against Grayscale, if there's a favorable ruling in favor of Grayscale, we could see these things move back to par. If a large player, say Fidelity or Charles Schwab, whoever wants to buy this and turn it into an ETF, that would bring it back to par. So there's that, obviously, that 30% gap there in the Bitcoin and 50% plus in ETH if somebody can figure out a way to make these shareholders whole.
So help me out here, JJ. If you're looking at this from a market participant perspective, this seems like easy money. What are the risks that are not obvious that people need to be aware of if they're buying the trust versus buying spot on an exchange?
Like I said, there's nothing tethering it to a price. So Bitcoin could go up to, say, 100,000, and you might be stuck in GBTC and it's only at $20. That's obviously an outlier scenario, but it's possible, right? So, and there's tons of tail risks. I'm not a lawyer, but you could kind of read their filing agreements and whatnot to find out the specificities of it. But you are entitled to the backing. You do own the backing of those shares. Whether or not you can ever redeem them for Bitcoin kind of remains to be seen, or whether or not this ever reaches par. But it creates kind of an interesting trade from an institutional perspective, and where you could long, say, GBTC and short perps or some other kind of structured derivatives trade where you can kind of profit off this and keep yourself delta neutral. And I think that may be what we're seeing now, potentially. We'll see if it continues throughout the week, but it seems like kind of the drastic increase in price over the past few days seems to be lining up, obviously, with the ETF filing of BlackRock.
What prevents the market from following another 3AC debacle?
Nothing. I mean, theoretically, you could take your shares, and if somebody's willing to give you leverage against them, we could see the whole thing play itself out again. But I would assume from a lender's perspective, there's nobody that's going to be willing to give you loans collateralized by GBTC anymore. I think that ran its course in 2022, hopefully. So
I think everyone's going to be scared that there might not be a premium on the next vehicle. Yeah. And that premium is what really ran that and fueled that trade for so long.
Yep, the 2021 mania, early January 2021.
When you say premium, JJ, Ben, can you just elaborate on what you mean by that for the audience?
Yeah, so the Grayscale Bitcoin Trust, that is able to trade at a premium to the assets that are held within the trust. So the share prices could actually be 100, 120%, 150%. I forgot how far it ran up, but it could be over 2x what the value is within the trust. So let's say there's $1 billion in the trust. The total amount of all the shares that are outstanding could be much more than that in terms of value. And that premium, that portion of the trust that existed, allowed for folks like 3AC to go ahead and send Bitcoin to Grayscale, receive shares at par value, and then once those shares were unlocked, initially at 12 months, and then a rule change allowed it to do a 6-month lockup, that once it was unlocked, they were able to go ahead and sell those shares in the market. And because the premium existed, they were able to profit on that. And then they would just recycle that same exact trade. And that's what really kicked off the Q3, Q4 type of price action back in 2020 was 3AC was doing that trade. They did it successfully, I believe. It was June or July. And then they went ahead and the filing came in at the end of December, and they were the ones behind all the December buying in that rally. So that vehicle doesn't quite exist. And if it did, I would not anticipate such a premium to come to market again. Even if the BlackRock is a trust again, I don't foresee that.
The best case scenario is just closing the NAV discount and getting back to par, which is still 36%. But yeah, I don't think it's going to swing wildly the other way, especially if there's ETFs that are pegged 1-to-1.
It's a market inefficiency that does need to kind of weed itself out. somehow, and somebody's going to figure it out. Whether it works this time or not we'll see.
It feels like dry powder for the SEC to come after the marketplace if it isn't being addressed.
Well, they're the ones that approved. That's the crazy part, is they allowed this product to exist and let retail buy it, and then they ended up over 50% underwater on Bitcoin holdings that should have been 1-to-1 if they had just approved a spot ETF. So that's kind of the crux of Grayscale's case against the SEC, and probably why we saw BlackRock filing is because it's highly likely Grayscale's actually going to win. As incompetent as their management team was proven to be in 2022, they're still more competent than the SEC when it comes to that. And they should have actually gotten the spot ETF that they filed for, if it's about the investors, which it probably isn't.
Excellent. It is all about the investors on this show. I won't make claims about what goes on in the halls of the SEC. You can take what I just said with a large dose of sarcasm. All right, let's move on, because I know we're going to have a discussion a little bit later on about the ETF that's going to be coming out from BlackRock. But Benjamin, you already talked a little bit about liquidity and how it hasn't actually changed. And you actually are going to share with us a metric that you have used in the past, and you're kind of bringing it back, the Jarvis fuel meter. Can you explain what the metric is and what it's telling us right now about the market and liquidity?
So back in the day, during the bull market, we figured out that using the USDT flows in and out of exchanges and the amount of USDT that also sits on the exchanges, how long it sits on the exchanges, and in what chain it sits on, whether it is the BTC's Omni chain or whether it was Tron chain or ERC chain, there were certain alphas which tells you that intraday level if the liquidity is healthy enough or not. So what it helped us to do back at that point is that you could do take profits if the health is dropping and if the health is improving. And if you have confluence with other metrics, you can get on a trade. And we had all that functionality back at that point, and we paused all of that when FTX crashed because, there's, of course, you have to wait and see how market comes back. And the thing is, after the SEC lawsuit on Binance and Coinbase, we have seen that health drop a bit more. It was at around 80 until the news came out, and it has dropped to somewhere around 47 right now. So the metric is between 0 and 100. It never goes to 0. 100 being very good, and as it trends down below 50, it's not that great. So we are right now dropping into the territory where the liquidity is not that great. It's not so healthy. So let's hope it doesn't get worse. If we get a DOJ news or any other bad news, it's quite certain that it will get worse.
So Benjamin, let me come in, just break in here. So this metric really is trying to get an overall market liquidity.
Yeah.
Availability. Okay. And you're saying, while we're seeing, just to reiterate part of the discussion we had earlier, while we're seeing some price action, the liquidity is actually fairly thin. This is under 50, which is not a terrible sign. It's not at 20 or below, but it's also not improving.
Yeah. There's two types of liquidity. When people talk about liquidity, there's two things. One is actual dry powder that sits on exchanges, the money that's moving in and out. The other that sits on the order books. The orders that sit on order books, you don't know if it is spoof or if it is real until it fills. It could just be a few market makers or someone running, a band-based trade across the books just to give the impression of liquidity. So we don't know how far there is real liquidity in the order books. But when you look at the USDT and USDC supply that is in and out, and the amount of time it spends in the exchanges and how it moves, there's a lot of metrics that we put on top of these in order to generate this fuel meter. So that's like an aggregate metric to very quickly see if there is very good liquidity in the market in terms of real money. So we consider over here that the stable coin is real money. So based on that assumption, we see whether, there is a better on-chain health when it comes to the exchanges. So we can feel a little bit safe about this trend. If it improves, that would be great. That would support what we would be looking at this rally, but otherwise we have to question it again.
And it's a on-chain metric, which
Yeah,
is,
it's an on-chain.
pretty unique, and you see the asset moving on chain. And, I think one thing people would like to hear from you, Benjamin, is kind of discussing if this on-chain movements regarding the treasury at Tether, and does that actually influence such a metric, and should they
Yes.
actually pay attention to it when Twitter starts blasting it?
Yes, so the mints don't have an influence, but when the money from the minted treasury moves to exchanges, you have to see where it is getting moved. Is it ultimately getting moved to an exchange cold wallet, or is it going and sitting in a hot wallet? So there's a lot of intricate details that goes into there in classifying which of those assets are real liquidity or which of those assets are just minted to keep as a reserve for future purposes. So we put together all of that and made this aggregate metric. So that's why we are able to consistently also predict to a certain extent whether this fuel meter indicates real health or not.
You mentioned that this metric was shared before, and you're kind of re-exploring it now. At the bull market cycle, what kind of measures are you looking for?
So during the last bull market, if I had to give you an example, we saw very good health in the first half of 2021 when price was around 60 to 67K of that sort. And the liquidity started dropping after that. And in the summer, when it started rising once again from 30 all the way back to 69K, the liquidity never went back to that all-time high. So it never went back to above 90. So at the peak of the market, it was really above 90. It was trending so good. It was so beautiful. But in the second half of the run, which was, basically the FTX or Alameda secured rally, they call it as in CT. So during that point, the liquidity never improved that far. So, and probably that was a bearish divergence indication as well. The liquidity is dropping while price is rising. That's not really the greatest of signs. But we had to pause it after FTX crashed, and we had to re-explore. We had to make modifications. We had to adjust the thresholds, and now we are quite ready to push it to the public again.
And this metric, will it be available on the upcoming Panda release?
Yes, we'll make it available there.
Excellent. Okay. Well, I'm very interested to continue to monitor this metric and others that you're sharing with us as we move towards the halvening. I think this is actually a good chance then for us to continue on to the next segment. We've got the rather quiet Cody today. He's been lurking in the background as he does his work on chain and trying to get us a good sense into the projects that are worth looking at. There's thousands of projects out there, guys, and that's why we asked Cody to take a look at just a few each week, give us his take. Is he going to like it or spike it? Cody, tell me, brother, are you here?
Yeah, here and ready.
Okay. All right. Well, that's enthusiasm right there. Okay. We're going to start with Frax. Frax announces xChanging its own L2. Like it or spike it?
I have to spike it as much as I like Frax. I don't know if this is the right move. So Sam Kazemian announced that they're going to do an EVM-based L2. So that's an Ethereum virtual machine layer 2 solution that will settle to Ethereum, right? They will use both optimistic technology and ZK EVM. They haven't gone into any details on how they're going to do that. I don't think I've seen someone else doing that. So it will be interesting what actually comes out of this. But I don't know if it's a good strategic move. Frax has famously gone into quite a few verticals. They started as a stablecoin issuer. They got some success, but they didn't really dominate the market, and even less so after the Luna debacle. They also went into lending. They created DEX. They did another stablecoin that is pegged to the CPI. And their latest iteration, which actually they've had quite a bit of success, is creating an LSD solution. So they have Frax ETH. And yeah, one of the things interesting about their L2 is that they're going to use Frax ETH as the gas token. And they might use transaction fees to reward frags takers, but I don't know. Like, I don't know what is the incentive for people to bridge to frags chain. Like, any chain that has had any success is a chain that has interesting applications that people want to use. And people want to use frags, but not nearly as much as they want to use some other protocols. Like any vertical that they've gone into, you can find another protocol that has had more success. So just pulling all the applications together in a chain, I don't think it's going to bring the success they want. So yeah, I have to spike it for now. If I do see that like some developers start to create interesting applications for their chain and whatnot, I will change my opinion. But for now, as much as I love frags, I don't really understand what they're doing.
Okay. So I have to say it. So fracked up is what I'm hearing. It just, it's such low hanging fruit. I know. I'm a dad now. I've got dad jokes. Okay, let's move on to the next one. We've got TAI or TAI. I don't know if I know how to pronounce that. An LSD-backed stablecoin and launches as a fork of RAI or RAI. Like it or spike it?
Again, I have to spike it. It also pains me to do so because I like RAI. For those that don't know, RAI is like the purest version of Maker and DAI. Maker started as a very decentralized and very idealistic protocol, but they kind of sacrificed some of their decentralization ideals in order to become more successful. So initially they started only accepting ETH as collateral, and then they moved on to different kinds of collateral, and now the majority of the backing is USDC, which is a centralized stablecoin. So a faction within Maker decided that this wasn't the way forward that they thought, and they created DAI, which is similar to what DAI started out being. They only accept ETH as collateral, but they implemented the big change, which is that DAI, the stablecoin, is not pegged to $1. So the value of DAI changes through time, and it started being at around $3. I think it's a little bit over that. Now it's at 2.75, but they really haven't had much success. And yeah, like I think, let me check on that. Yeah, they have 3 million DAI in circulation, which equals to almost 9 million in market cap. This is just tiny. It's tiny. Like USDT has 80 billion in circulation. USDC around 30 billion. DAI less than that, but still in the billions. So like no one is looking at DAI, no one is using DAI. Liquidity is awful. So the protocol still works, but the algorithm that they use to establish price for DAI works, but it hasn't had much success. And DAI is basically just the fork of DAI, but they use LSD tokens as collateral aside from ETH, and they also use DAI as collateral, but again with 3 million DAI in circulation, that doesn't really move the needle.
So you're spiking this one though.
Yeah. I don't think they're gonna get much success. They are trying to create let's say a bit of a flywheel. By issuing rewards, they're issuing a lot of governance tokens to the people that use DAI in the beginning, and they have had a bit of success. They reached 15 million in TVL, but now that has already halved in like a few days. So I don't know. I think people just don't want to use a stablecoin that is not pegged to the value of a real life stable. Like it's too complicated. The way that DAI works is also too complicated for people to understand. People like simplicity, and yeah, I don't think this is the way forward.
A lot of information to digest there, but I think the crux of it is we're going to spike that one. Let's move on to the next one. Sui dodges shutdown after Certicade discovered hamster wheel attack.
So,
that sounds horrible. Like it or spike it?
Well, I spike Sui. I like Certic. So, yeah, Sui had the bug in their code. It's a newly discovered bug from Certic. they call it a hamster wheel attack. And basically, it someone could create an infinite loop that would make the chain inactive until the issue was resolved. So the chain would not be destroyed irreparably, but no one would be able to use it unless this issue were resolved, right? So it's quite a terrible bug to have in one of the biggest blockchain that has launched in the past like years almost. They have massive funding. They have some of arguably the best engineers coming from Libra, which was a Facebook project, and they have been hyped up to no end. And it's just not great to see this, especially, yeah. So I don't know. I guess it's better that they caught it early, but definitely not a great look. But it is great for Certic. They've had a lot of really bad publicity, and it's nice to see them get a win because they are a good team, and some of the services they provide for auditing do not really go into as much detail, and they have got red-handed on that. Some of the protocols that they've had audited in the past few weeks have been attacked, and people have lost money, and they have turned to Certic to blame them. I don't think the blame lies with them. The blame ultimately always lies with the protocol creators. So yeah, happy to see Certic catch a win. Try a win for Certic.
Okay. All right, we've got this last one here. We've got Ambient Finance, which went by CrocSwap before, is forced to launch as Uniswap V4, which is heavily inspired by Ambient, is announced. Like it or spike it?
I like it. The fact that, well, it's not a fact, right, that Uniswap V4 was heavily inspired by Ambient, but if you look at the offerings of Uniswap V4, which is by now it's only an idea or like proposal, they have some contracts developed, but they haven't launched yet. And if you compare it with Ambient Finance, they look quite similar. And Ambient Finance, aka CrocSwap, has been in the works and basically done for months now, and they introduced some of their ideas over a year ago. The issue that they've had is they've had regulatory issues. The team is based out of the US, so they have had to push back the launch of Ambient Finance. And I think they wouldn't have launched unless Uniswap V4 had announced that they were gonna, unless Uniswap had announced that they are gonna release V4 shortly. And seeing as how they were gonna basically just copy them and either launch, Ambient Finance has finally launched. They introduced some really interesting innovations. The main one being that the pools for trading are not gonna be separated. All the pools are gonna be in the same contract. Gas is gonna be much less, both for LPers and users that transact within Ambient or Uniswap. There's going to be limit orders enabled. There's going to be different kind of pools, so like concentrated liquidity or UniV3 style liquidity and UniV2 style liquidity, dynamic pool fees, etc., etc. The main difference between the two of them is possibly that Ambient Finance is completely open source. People can work on it and fork it, build up on it and whatnot. Uniswap V4 is not. Uniswap V4 will allow people to build on it, but will not, as far as I know, like anyone reap any benefits from it. So you can look at their code, but you cannot really do much else from that. And I think their license expires in 2027. So yeah, as a decentralization maxi, I have to side with Ambient Finance here. And I'm really glad to finally launch.
Well, the question I have, given the dominance that Uniswap has, how likely is it that Ambient Finance is able to put in a dent in their ownership of the market? Do they have a real chance?
I think it depends on how far Uniswap V4 launch is. If they can get a bit of a head start here, if people start using Ambient Finance and they attract a significant chunk of liquidity, I think they could be a true rival to Uniswap. If not, Uniswap will just run with it. Like their position is just too dominant right now, as you say. So rooting for Ambient, but they're definitely the underdog right now.
All right. Guys, any questions for GigaBrain Cody before we wrap up, move to the next section?
Ambient's got no token, right, Cody?
They don't, as far as I know, but I put not Solana Bible on that, let's say.
If that's the case, I mean, I kind of find that bullish in a way. Not having to have that overhang of a token and those governance decisions and then get into that whole mess of decentralization, that allows them to kind of keep their head down. Because, anything I know about Ambient, just for full disclosure, really comes from Cody, and him and I were talking about the benefit of how Ambient will remove just-in-time liquidity, which is something that is prominent in V3 for Uniswap and really impacts yields. And most don't really realize how much it does impact it. And for that reason, outside of the fact that most of retail doesn't know how to set those liquidity bands in the most effective manner to maximize their yield capture. And I think I read a study from, it might have actually been the folks at CrocSwap/Ambient Finance, was that anybody who goes ahead and sets those bands over time, the effectiveness of capturing liquidity and trading fees diminishes over that period of time. So longer it is, the worse their yield gets. And for that fact, V2 is actually a much more beneficial, from my understanding, in terms of capturing yield for retail, where this improvement over V3 seems like a great win for retail in general, which is exciting to see.
Yeah, just to give some more color on that, Uniswap V3, as people put now, implemented concentrated liquidity, and that is great for efficiency, but it's not great if you are an AKA lazy liquidity provider, which just give some tokens to the pool and just sit and don't really change much. One of the biggest issues comes from MEV quote unquote attacks. So if someone is trying to do a swap and they just happen to do it on the liquidity range that you are quoting for in Uniswap V3, what can happen is that an MEV bot or searcher see that transaction is about to happen, and they add liquidity to the pool within the same block just before the transaction happens. So they add a lot of liquidity concentrated on a really small band. They get the yield from the transaction that is about to happen, and then they remove liquidity. So they get paid the lion's share of the fees for that transaction, and you, the lazy LPer, get basically nothing. And yeah, the guys at Ambient Finance see this as an issue because it's difficult to get liquidity providers that will stick with you if this keeps on happening. One of the reasons I think is that people are not really aware of it, so they don't really put it into their calculations. But the more people are aware of it, the less they are willing to provide liquidity. And yeah, Ambient Finance is trying to get rid of this issue. Let's see if they are successful at it. What was that, Ben?
To put it plainly, we're pro lazy liquidity providers. We actually gave them a label that are just LARPers.
Yeah,
short. So we're pro LARPers.
Yeah, it sounds like a very interesting solution to a real problem in the space. So yeah, very excited to see how they evolve and if they're actually able to get some traction. So we'll definitely keep an eye on them. All right. Well, thanks, Cody, for sharing your thoughts on those 4 projects. Let's move on and talk about what has really been the belle of the ball over the last week. On June 15th, BlackRock announced it's launching a Bitcoin ETF trust. And for those who have been in the space, well, at least since the last run, everyone was talking about Grayscale being able to convert their trust to an ETF. There were several other applications that were submitted that were denied. Now that BlackRock is putting its hat in the ring, it feels as though the game may be changing. And Ben, you wrote a piece all the way back in 2021 where you compared the or rather you looked at the price of gold as an ETF took off over a period of time. I'd like you to revisit that piece and just give your thoughts now on sort of what was the takeaway and what that may mean if this BlackRock ETF moves forward.
Sure thing. It's been some time, but looking through these charts as I pull it up right here, some of it comes back to me. And really my main takeaway is, this is what happens when an asset has greater accessibility. I mean, even before the gold ETF, like in the 94, 95 timeframe, online trading became more easily accessible to the everyday person thanks to whatever changes took place on the internet and brokerage accounts online. And if you go ahead, you pull up the S&P 500 and look at the index price from the mid-90s on, you'll see just a steady march up. And when we go ahead and pull up gold ETF, in 2003, Australia had the first ETF in the world. And then about a year later, in November 2004, we got GLD, which was the US's first ETF. And the price action didn't really respond right away, but if you go ahead and zoom out, you can kind of see that steady march higher over the next 7 years, reaching a high in 2011. And it really speaks to the gold market having more market participants come in, because you don't need to purchase as many shares of gold as you did beforehand. So now you can essentially get fractionalized shares of gold, which should sound familiar for everybody here. So this alludes to the fact that with this ETF, we should have greater accessibility into this asset, and it will be a slow march higher, a subtle and constant demand shift change over time for the market.
I'm curious if anybody here thinks that there is a bearish stance on BlackRock coming to the table with an ETF.
I mean, if you want to be really conspiratorial minded, you could spin up any scenario, right, that would fit your narrative with it. But I think it's, again, like we said before, like sometimes bullish things are just bullish when you have the biggest asset manager in the world. Like, they see the dollar signs behind it. They see the kind of volumes that were being traded in 2021. It just makes sense. Just from a purely, you don't even have to have any kind of attachment to crypto. It's just a profitability thing. Everybody wants a piece of the pie. And obviously BlackRock knows how to engineer liquidity and get these things into the hands of retail traders and brokerage accounts and across the board, and people who want to hold it in retirement and whatnot. It's overdue, I think. And now it's just kind of crossing that threshold into the period of mainstream adoption, which, like Ben said, could fuel kind of a multi-year cycle. Not necessarily to say it'll be straight up in a line from here, but I think it'll go on one of those runs where it'll be obvious in hindsight that this was probably a good time to begin averaging in.
Did I just hear whispers of the super cycle?
Yeah, ironically, now that Sue's been eliminated.
Yeah, now that he's capitulated.
Or
yeah, not capitulated, but forced liquidated.
Forced liquidation.
I'm curious about the adoption curves. Like, everyone's going to say, like, oh, we're going to see peak adoption now of this asset class. But in my opinion, that's not really what's taking place here, right? This is not people going ahead and using Bitcoin as a peer-to-peer asset, right? This kind of leads to what Ben Hunt's always talked about, which is Bitcoin TM. Does that, I'm curious what some people think about that here, because that is a real concern. What does that do to Bitcoin in the long run?
I think there is that aspect to it, right, where it becomes like gentrified Bitcoin, like Ben pointed out, where it's just kind of, you own it in a brokerage account, it's traded in dollars, everything's denominated in dollars, the Bitcoin's not actually moving, it's not alive, it's not part of the network. But I think on the other side of that is it also kind of shifts the Overton window a bit, where all of a sudden people who would have never otherwise had interest in Bitcoin now might start taking interest. And maybe that leads to them eventually wanting to hold their own private keys and things like that. It kind of remains to be seen. Who knows? I think most likely it probably just ends up into a neutered product or so. But
that's kind of been my opinion too. But with this kind of resurgence of ordinals, holding Bitcoin in your wallet and kind of really having that self-custody aspect of the ordinal itself or the inscription on the Satoshi kind of changes the game where, yeah, you're going to have like a percentage of Bitcoin locked up into this ETF and traded in the secondary market that's not fully on chain. And then on the other half, you have a percentage of supply that's going to be taking part in this kind of more organic demand, assuming that it's not just a bunch of monkey JPEGs.
Yeah, I think it will. Like, I think the premium for spot Bitcoin will probably increase over time the same way we've seen that with gold. Like, I think if you actually go and buy gold from your local gold dealer, you're going to be paying way more than you would if you were trading gold futures, just because there simply isn't enough spot gold to go around. And I think we'll probably reach that similar point with Bitcoin where there'll be the hardcore adopters and then there'll be the price you see on the screen, and there'll probably be a chasm there. But I think the thing about that too is like it's a lot easier to take physical receipt of Bitcoin than it is gold. So who knows how those kind of X factors play out as these things increase in adoption and what could kind of come of it. It's interesting.
Another interesting thing about ordinals is that I think for the first time people are transacting and quoting things at scale on like using Bitcoin, aside from like some randos buying pizza and whatnot, and yeah, like it was implemented in El Salvador. They could pay with Bitcoin, but I don't think it has had much success really. On ordinals, people are transacting using Bitcoin same as they are using Ethereum for NFTs on OpenSea and whatnot. And yeah, as you said, JJ, transacting with Bitcoin is much easier than with gold. So I don't know if it will have the same fate as gold, and hopefully Bitcoin doesn't. It is not just transformed into Bitcoin TM as Ben and fears.
That's an interesting point you bring up, Cody, though. Like things are getting quoted in Satoshi. Now, this is that whole argument. Like, I'm never going to see my cup of coffee quoted in Satoshi. No, you're probably not, because that's not a good of the Bitcoin network. Where when Ethereum had the JPEG show up, we started to see this market dynamic where everything was starting to get quoted in ETH, and people didn't necessarily tie the amount of ETH to the price of the underlying asset or just the market price of ETH. Right? It was always 0.02 ETH was what somebody would require for minting a JPEG. And with Bitcoin, if that market starts to materialize, like you have this mini economy now springing up within Bitcoin, which is,
that's what I think.
For like their words, beautiful.
When I look at it, I think the knee-jerk reaction is to think of like the Trojan horse scenario where BlackRock's coming in with the Trojan horse. But I think ironically, like Bitcoin might be the Trojan horse and they're letting it in the gates willfully by kind of just being motivated by pure greed and money. And they're going to be like, hey, we're going to make this ETF and we'll figure out a way to tame it. But they just might end up pushing the Overton window and these things accelerate as price goes up in the years to come. It's interesting. We'll see.
Fascinating perspective on how this could transpire. I'm very interested to see what happens with ordinals, what happens with proposals like BIP 300, where some people are pushing for drive chains that could further, I guess, create a larger canvas on which Bitcoin could operate and perhaps extend the size of the economy such that the Trojan horse idea that you have, JJ, could become a real reality. Yeah. It's a very interesting question. I know we're getting to the end of the show here, so I'm going to wrap up with a fun question, as we always like to do here, since everyone's so serious. This week, or recently, Citadel announced that the EDX Markets, which is a crypto exchange by Citadel, Fidelity, and Schwab, is now live, where you could be trading cryptocurrencies. And we're laughing because we think about Citadel coming into the market, and I'm just curious, if you were in a coffee shop and you met the CEO, Mr. Griffin, what would you say to him? Ben, what would you like to say to him?
I would just ask him, where do I submit my trade data? Let's just get this over with now.
Just out of the way before you make a trade. Just be like, hey,
yeah.
Go ahead.
No, I was just saying, here's my email account. Here's all my other information. Can you just tap directly into my brain? Maybe you could get my other ideas for me as well.
Just go ahead and front run me. I would just borrow a quote from Joe Strummer of The Clash. He who hugs nuns will later join the church. I think that's the case with Bitcoin and all of crypto. Once you're in, you're in. So I think we're going to make a degen out of them before this is up.
Did I hear you right? Did you say he who hugs nuns will eventually go into the church?
Well, it's actually a much rougher version of that, for the sake of self-censoring here.
Okay.
But I met anybody that's been in crypto and has done well in it that turns their back on it or rejects it. So I think we'll turn them into a crypto native before this is all said and done.
I'm just still stunned at this quote. I think I'm going to have it tattooed somewhere on my body. That's brilliant. That's going to do it for this week's show. I want to thank JJ, Ben Lilly, Cody, and Benjamin for dropping by. Guys, every time we get into this discussion, I always learn a lot, so I appreciate you guys taking the time. If you're looking for more content, be sure to subscribe to xChangingGood.com, the Exchanging Good channel, because this is where we're putting out all the information. I actually already gave it away. We have more coming. We've had a lot of requests coming in. Where's the data? How can we interact? How can we get more information? There's going to be more to come on that. And if you stick around and subscribe to this channel, listen to the podcast, we're going to be sharing that as we develop more of those ideas. We don't want to just go out there with, I'd say, what the rest of the market's doing. We've got some other ideas that we're going to be putting forth. We're really excited about it, but it takes a little while to build it up. And I know you're going to enjoy it as well once we actually put it out there. So that will do it for this week. This is Marconi. I'm signing off. Until next time, take care, be well. We'll talk to you soon.